Welcome to Trader TV. I'm Dan Barnes. Joining me today are Charlie Campbell-Johnston of Tradeweb and Joeri Wouters, Senior Fixed Income Trader at KBC Asset Management, to discuss the role of automation in improving trading and delivering better returns for investors. Charlie, Joeri, welcome to Trader TV.
Thank you very much for having me.
Glad to be here.
So Joeri, why should an investor care about trading automation?
The most obvious reason, of course, is efficiency, because we want to free up the time for the dealers to work on the more difficult high-touch trades or to work on projects that add value to our desk. Automation also decreases the risk of slippage. So definitely when we have to execute a larger number of trades at a given time in the day, for example, the orders that we do for our passive funds at the close. Additionally, using a quant-based methodology for your counterparty selection strengthens your best execution policy and proofs. It creates a uniform process across the desk for all the dealers, basically eliminating human bias. And finally, the same tools and analytics that we use to automate part of our flow can also be used to improve our price discovery and counterparty selection methodology for high-touch orders.
What we're seeing is not only that the capacity can increase as people trade more often, more frequently in more asset classes with often no increase in headcount or certainly operational budget, but we're also seeing examples of where automation is actually becoming an enabler to new types of trading activity. One example would be in the leverage space for derivatives, where you're seeing automation bringing in the systematic funds to trade in a way that they wouldn't have done historically.
Which parts of the trade can be automated and how does that differ by instrument?
Typically, we will start with a client who is taking a sort of holistic view of their trading activity across multiple asset classes. And then over a period of time, as they get more comfortable and build up enough of a data set to be able to understand and quantify the results, then we can move further and then pull back if liquidity situations determine that now is not the best time to be automating. And that tends to be the same dynamic that we follow with a number of clients, but they tend not to have the same trading objectives at all. They differ quite significantly.
We started with automating our government bond flow already a few years ago. Initially, it took us hours to amend our selection criteria on a frequent basis. But with Charlie and his team, we created a workflow that only requires a few minutes now.
Wow.
The next step for us, and I think this one is an important one, is an internal project that we are working on at the moment. So we are going to try to use machine learning techniques to make predictions on the best counterparties to inquire. And we're going to do that not only for the markets where there's a lot of data like govies, but we're also going to try that for credit and EM. We're going to use a broad set of data like historical hits and pass rates, slippage versus screen prices, X's and so forth. I think it's also very important to mention that this is new for our desk. There is no guarantee for success, but we hope to validate the first results by the end of the year.
Does the best execution process change for low-touch trades?
Yes, it changes in the sense that you will end up with a more uniform process across your desk. The increased use of data will result in a selection methodology that is less biased per dealer. I think that's already very important.
Yeah.
You also have to spend more time and more focus on the explainability of your selection criteria, because that's often forgotten. You have to be able to understand and clearly explain to all the stakeholders why the tool took a certain decision. Additionally, low-touch trades we feel do require an even closer monitoring. As this is often rule-based, constantly analyzing the data and the rules to improve the selection criteria is important. I think data management is really key here. And then finally, I think it's still important that your dealers keep close track of the market and how the market is behaving, so they can intervene and trade manually if need be in times of stress. Because as we've seen the last few weeks, the markets can turn very ugly very quickly.
Absolutely.
Since MiFID II, there was a change in shift from the line-by-line execution, best execution policies to more of a process-based execution policy, which actually sort of dovetails very nicely with a sort of rules-based approach, because what you can do is you can implement a set of rules for a certain sector and evaluate the performance based on the criteria that you set that within your policy. Joeri's talked about slippage, for example, but different profiles. So some of the big index houses, for example, will care far more about matching a benchmark, for example, or getting the trades done over a short period of time. So the ability to be able to say this set of rules has this outcome according to this metrics and analyze those systematically and adjust them according to different market conditions becomes very valuable, but also changes, I guess, the nature of the role of the trader in some instances to become much more data focused in analyzing that data.
Charlie, Joeri, thank you very much.
Thank you.
Thank you.
I'd like to thank Charlie Campbell-Johnston and Joeri Wouters for their expertise on today's show. Join us at tradertv.net and etftv.net to catch our shows on other instrument classes and other investment types.